Good evening, class, and welcome to our taxation class. As you can see on the screen, the topic for today is taxation of business income. And so we'll be looking at basis of assessment of profits of a sole proprietor, partnership, and company. Now, I would like to tell you that sole proprietorship, which is a one-man business, partnership, which is a union of 2 to about 20 people, and for professionals like accountants and lawyers, it can go up to 50 people, and a company from 2 to any unlimited number could do business. And so the basis of assessing profits, which will be used for tax, is the same for all three. So when I teach you basis period, it's the same for all these categories of business people. Now, for the sake of time, we'll be taking just one question that will highlight everything you need to know about basis period. Now, basis period is like when you receive your NEPA bill for the month of August, August 2020. If you look at the bill, for those who are not using prepaid, who are using estimated, you will see that they will tell you period July 1 to 30. But they call it, they will send it for August and they tell you this is your August bill. What does it mean? It means that they are using what they call preceding month basis. Preceding month means we are in August. The month just before August is the preceding month, that is July. So you cannot be in August and you are asked to pay for what you use in August. It is what you used in June, is in July, that you'll be asked to pay in August. That's preceding month basis. So in tax, we use what they call preceding year basis. Preceding year basis now means that we are in 2020, your account that you will be checking for assessable profits and tax should be an account ending in 2019. Now, there are three characteristics of any account that is having what they call normal basis period. A normal basis period is 1, it is 12 full months. It is not 11 months and half. It is not 10 months. It is not 13 months. It is not 15 months. It is 12 full months. And so when you see in a question and they tell you something like this, period ended June 30, 2007, it means this is not 12 full months. That's why they will use the word period. When they say period, it means it's either more than 12 months or less than 12 months. Now let's look at this period. This period would have started from April 1, 2006 to June 30, 2007. How many months make up this period? So let's count. April 1 to ending of April is 1 month. To May ending is 2 months. To June 2006 is 3 months. So 3 months. Then if you count from July 1 down to June 30th, 2007 is another 12 months. So 12 plus 3, this period is a 15 months period. And so this does not qualify for normal basis period. Okay? Then the second characteristics of a normal basis period is it starts from where the second one stops. So we have seen two characteristics. So let's look at this year ended June 30, 2008. Now, the word year ended means it is 12 full months. So it has captured the first characteristics, 12 full months. The second characteristics, they say year ended. If it is 12 full months and it is ending in June 30, when did it start? I have a nice formula for it. If this ends June 30, 2008, how will you know when it starts? I will just simply say, assuming you are standing on today's date, June 30th, 2008, simply ask yourself, if today is June 30, what is tomorrow's date? Tomorrow's date will be July 1. So another account will be starting, since this one ends June 30, another account will be starting July 1. If another account is starting July 1 that will run for another 12 months, it means this present one that ended in June 30 must have started in July 1. And so when you say, what is tomorrow's date? July 1. Then you now backdate it by 1 year. So you say July 1, 2007. July 1, 2007. So that means if this one ends June 30th, 2007, the next account is July 1, 2007 to June 30th, 2008. So you see, it is normal based on these two counts. So thirdly, the third thing that makes any period to be a normal basis period is that it must have only one period, one accounting period ending on the preceding year. Okay, so see this year that we talk about, year ended June 30, 2008. It means that normally the year of assessment is say looking at the preceding year basis. So if this is the basis for the account and it is ending in 2008, that means the year of assessment is 2009. So when we look at 2009 year of assessment and we look at the basis period, there must be only one date ending in the preceding year, June 30, 2008. So if you have two, then it has violated the law. If one of them is ending in March 30th or 31st, 2008, and another one is ending in June, then there is a problem. That means the one that ended in June would have started from April. So you have April, May, June to just be 3 months and not 12 months. So you see, it must have only one account ending on that preceding year. So these are the three characteristics of a basis period that we call normal. But then life is not always normal. This is because business can start up anytime. For example, business is not compulsory that your business will start in January 1 of every year. It's not even compulsory that you must keep your accounts December 31st every year. But you know, in Nigeria, it's so proprietary. You can when you register your account with CAC, normally it's 31st December every year that you are being expected to keep your account. Fine. It's just companies that normally use they normally choose a particular date because a company is different from a person. A sole proprietor is on direct assessment. So that's why his own has to end in December 31st. Partnership, the same thing. But company, you can choose any date as your date that you are making up your books. But for the sake of exam, even those that are not company, who may want to use it that they can choose their own account. But normally you expect for a non-company, that is anything that is not limited or PLC, we don't call them company, we call them just business. They will normally end in 31st December. Now, there are three situations that will bring abnormal basis period. And these three situations are: one, when a business is just starting. Like you can see in this case, the business started in April 1, 2006. So the first year is going to be, your year of assessment will be 2006. It started April 1, 2006. So your first year is 2006. Now, if your year of assessment, which is year one, is 2006, normally your preceding year basis should apply, but it doesn't apply here because you started the business 2006 and they are taxing you in 2006. So on the first count of the preceding year basis, it doesn't hold. Secondly, it is not 12 full months, because if you count from April 1 to December 31st, it will not give you 12 full months, except you're starting from January 1. Then thirdly, year 2 will not continue from where year 1 stopped. So all these are what we are using before this finance bill or act 2019 came up and corrected their anomalies. In the Finance Act 2019, it's only the first year when you started business that is abnormal. Second year, third year, and all that does not show abnormality. Okay, now the rules for commencement is this. When you are commencing a business, there are 3 years you need. You need the first year the business started, the second year the business started, and the third year. And what do you do with those years? Looking at this as an example, you say that 2006 is the year the business started, because how will you know? They will tell you the date the business started, and that gives you the date of commencement of business. So what you do now is April 1, 2006 is the date the business commenced. That means on year 1, you call it 2006. It must be from the date the business started to 31st December of that same year. So if you look at it at the solution, that is what we used. April 1 to December 31st of that same year. Now, year 2, the second year, which is going to be what? 2007. 2007, we are trying to do 12 full months. So the second year, which is 2007, will be 12 full months from the date the business started. And you count 12 months. So when you count 12 months from the date the business started, I will not ask you to start counting your April, May, June, July. Just ask yourself, if today is April 1, what was yesterday's date? Because we want to know the ending date. What was yesterday's date? Yesterday's date would have been March 31st. So March 31st, bring 1 year forward, 2007. So this one would have run from April 1 to March 31st, 2007. And that is what we have here. That is the second year basis period. This is 12 months. Now the third year is when the preceding year basis will really start. Now, what will happen here is the third year, which is 2008, you'll say this is when preceding year should start. So you ask, if the year is 2008. That means the end date must be ending in 2007, right? Fine. That means any account ending in 2007 is what will be my basis period. So this is 2008. You look at this thing, this is 2007. The company keeps bringing their books up to date for account June 30. Excuse me. June 30th. Excuse me. June 30th every year. So you say, for the third year, I must end my book it will be June 30, 2007. That is your end date. What will be your start date? So if you're looking for start date, all you need to ask is what is tomorrow's date? If you're standing on the ending date, ask yourself what is tomorrow's date? July 1. You bring 1 year backward. July 1, 2006. If you're in the beginning date, trying to look at end date, just ask yourself, what was yesterday's date? Then you bring 1 year forward. That's how we use the date. So if you look at it here now, it's July 1, 2006 down to June 30th, 2007. This is not the question we are going to be solving, but I'm just using it to teach you the dates because we're going to be solving one difficult question now. But now that you've done that, that is what they call right of election. Right of election in commencement of business is the right that the taxpayer has to pay a lower tax. You know, when you do all of these using these rules I gave you, it will result to a particular tax. But you have the right to tell the tax authority, shebi in year 1, I did actual year basis. I used year of assessment 2006, and I started from April 1, 26 to December 31st, 26. Why can't I do the same for year 2 and year 3, such that I will say year 2 is 2007. I should start from January 1 to December 31st, 2007. That is what we did here. January 1 to December 31st, 2007. Then in the next year 8, that's not like preceding year basis now. This is what we call actual year basis. You come here January 1 to December 31st, 2008. So they are actually rhyming with the year of assessment. So when we say actual year of assessment, it means January 1 to December 31st of that same year. That is for an existing business from year 2 downward. For year 1, actual year basis means the date the business started to December 31st of that same year. For a business that is collapsing, ceasing business, actual year basis means January 1 of that year to the date the business ended. That is actual year basis. So what do we do when we do right of election? Already year 1 is already in actual year basis. So we compare year 2 and year 3. So we compare their figures, year 2 figures and year 3 figures. We add them together, as in this case here. We add them together to get a particular figure. And we compare it with what we did before, which we call the normal basis. We compare year 2 again, which is this, and year 3. And when we look at the figure here, which is smaller than this figure. So because that figure up here is smaller than this figure, we will go for the smaller figure. And so the advice would be, do not exercise your right of election, because if you exercise, you will be having a higher accessible profit, which will lead to higher tax. But if you say, okay, let me just follow the normal way, you will get a smaller accessible profit, which will lead to smaller tax. So this is the one time that the taxpayer has the right to elect which method to use. And it only applies for year 2 and year 3. When it gets to year 4, you continue from where you stopped at the normal basis period. So year 4 is going to be 2009. You are going to start counting from July 1, 2007 and ending in June 30th, 2008. That is how you'll be continuing the process. So from year 4, from year 3, you have established what you should be doing. Like look at year 3, you started from July 1, ending in June 30. That is how you will be continuing every year. Every year you'll be starting July 1, ending June 30. So you have established a 12-month accounting pattern. So that is how you follow that pattern until the day you decided to change your accounting date. Now, you change your accounting date, let's assume that you used to bring your account to March 31st every year. Let's assume that is what you used to do. Like it's in this case here now, you see they used to bring their account March 31st every year, as evidenced here, that this is from April 1 to March 31st, 2006. Fine. That is how it has been going from year 3 down to this particular year. Now, in the year 2007, it decided that it wanted to change from 31st March to December 31st. Okay, so that would mean that there are some reasons why they want to change. It could be that they have a parent company who will need to do some consolidation, and if they are doing December, you cannot be doing March, and they are doing December, you may have to shift to change to their own style. Now, when you are, whatever reason you have for changing your accounting date, there are 3 relevant years that are required. The year the change was made. That is the first thing you should spot. The first year the change was made, call it first relevant year. Then the year after it should be your second relevant year. The year after it should be your third relevant year. So you need 3 years. First of all, you need to identify the year that the business changed its accounting date. I will tell you how to identify it. Then the 2 other years following it should be joined together. So now how do you know the year the business changed? Now if you look at this account here, this is 2007 year of assessment, right? This is 12 months. Fine. This is 12 months. Full 12 months. And now this account ends in 2006. So it's a 2007 year of assessment. So if you look at this question, say it's 2007 assessment was based on the account of April 125 to March 31st, 26, which is what I showed you on preceding year basis. So it followed the 3 requirements. But look at this second one. You cannot see period. That's a problem. 12 months is not achieved. That's a pointer. 12 months is not achieved. And it starts from where this one stopped. Okay? It starts from where it stopped. That's fine. But it is also ending in the same year, 2006. So mind you, I said no 2 accounts should have ending date on the same year. So this one has violated. So we can't be having two accounts ending in 2006 because this is 2007 year of assessment. This one is also 2007 year of assessment because it ends in 2006. And now there is a problem. It means that in 2007, there was a change of accounting date. That is what it means. You have identified the year of change. Look at this period now. You see that this is less than 12 months. It's just 9 months. And you see it's ending in 26. That's the pointer. It means 2007 was the year of change. Having identified 2007 as the year of change, you also need 28 and 29. What do you do with those dates? 27, 28, 29. Now, you will do what they call old assessment date, or old assessment date. What do we mean by old assessment date? Old assessment date is our accounting date, is this old date that we have been bringing, March 31st every year. So you will just assume that the business did not ask for change. So for those 3 years, you will be doing as though they never asked for change. So you will use account ending in March, and not December. And so you will adjust all these things to suit all of that. Now, after doing that, you get, look at what we did here. We're still going to solve one problem to see all of this. So if you look at it here, first relevant year was 2007. And you see, we are still using accounting date ending in March. The second relevant year was 2008. You still see it is still in March. Continue where this one stopped. 2019, we are still using up to March. This one is continuing where it stopped. So it didn't violate the rules of preceding year basis. It didn't violate the rule of 12 full months. But the problem is there's going to be an overlap somewhere, somehow, when we are doing 2007. So that's why it is abnormal. So what you will now do, after doing all of this, you add these 3 figures together to get this. Now, when you get this, this is using old accounting date. You also now come and use the new accounting date. You will now pretend now that, yes, okay, you've asked for change. Let me grant your change. Now, this is where the problem is now. Assuming this is what we used, you see, 2006 would have ended in March 31st, 2005. Yes, so 2007, starting in January, there is a gap, which is a problem. That's why it is a abnormal basis period. So if you look at this first year, there's a problem here. That is, this first year is just the reason why it is abnormal. Now, you see that 2007, you say preceding year basis is must end in 2006. So use the new accounting date. New accounting date is December 31st. So you ask yourself, what is tomorrow's date? January 1, then you bring it that same year. January 1 will be the beginning of the account ending in December 31st. Now, don't call this one actual year basis, so because it starts January 1. No, it is still preceding year basis because this is 2007 and the date ending here is 26. That's fine. You do the same thing. This is 2008. The date ending it here is 27. This one starts where this one stops. The same thing occurs here. The important thing is to add this figure here with this figure here and this figure here to get this figure here. When you add them together and you've gotten a figure, and you have to compare just the way we did in commencement rule when we are doing right of election. You will now compare, but this time you are comparing 3 years, not 2. In commencement, we compare year 2 and year 3. But in change of accounting date, we are comparing the 3 relevant years. Now, unlike commencement rule where the taxpayer have the right to choose, in change of accounting date, it's not their fault that you want to change your accounting date. So the tax authority will be the ones to choose. And what do you think the tax authority will choose? They will choose to favor themselves. They will want more taxes, and so they will choose the higher. So whether you have changed your accounting date from March to December, as long as this is higher than this, for these 3 years, 27 to 29, they will use these figures, 120, 135, and 185. And they will not use this 105, 240, and 28. Now, it is important to note that after these 3 years, and you want to continue, you will be continuing based on the new accounting date. So, irrespective of the fact that they choose this, your 2010 accounting year will be January 1, 29 to December 31st, 29. Whether they choose this one or not. Whether they choose this or not. The reason for doing these 2 methods is to look for which one will give the tax people more revenue for those 3 years. And so you keep following this new date because you've changed from March. You've changed from March to December. So you keep following this new date until there is a need for you to change again. Then if there's another need for change, you do the same process. But every, like a sole proprietor, when the owner dies, the business collapses. So let's assume that as a sole proprietor, the owner now dies and the business collapses. Or maybe the owner did not die, the business, due to economic meltdown, the business collapses. So that means you will get another period called the cessation period. Now, in the cessation period, before I go to the cessation period, the Finance Act 2019 does not talk about the change of accounting date. So it doesn't affect the Finance Act 2020. What affects Finance Act 2020 and 2019 rather is the commencement and cessation because of the actual year basis involved. Okay, now the business has been bringing accounts. Let's assume that the business was bringing accounts every year, ending in June 30th every year. Every year, that is what it was doing. Then, after a period, the business now came to an end in 30th September 2009. What do you do? Okay, now there are 2 accounts, 2 periods that you need. You need the year the business ended. That's the first thing you should spot. This year the business ended, you need it. And so if the year the business ended is spotted as 2009, you also need the year before the business ended, which is 2008. So you need 2 assessment year, 2008 and 2009. What do you do? Normally, when you were in 2008, you prepared your account based on going concern, showing that in the foreseeable, you didn't see the business ending in the foreseeable future. Okay, maybe you must have seen some handwriting on the wall, but you think you can still patch and manage. So you gave your business account as the law prescribed in going concern. But in the 3 months after that, you find out that, oh, I cannot continue. So the business ends. So you have identified the year the business ends. The year before the business ends, you have to identify it. There are two things you will need to do. Normally, the year before the business ends, you would have done preceding year basis, just like we have been doing preceding year basis. But when you get to the year the business ends, you will do what they call actual year basis. So look at it here now. This is 2009, September 30. All you now need to do is actual year basis. Actual year basis, I told you, for a business that is ending is January 1 to the date the business ended. Actual year basis. For the final year, we call that year ultimate year. Now, the year the business before the business ended, the year before the business ended, we call it penultimate year. So if 2009 is the ultimate year, 2008 is the penultimate year. In 2008, which is the penultimate year, you must have done preceding year basis. You must have done something like July 1 to June 30, 2007. That is basis period for 2008. The law says after doing the penultimate year on preceding year basis, go back and do actual year basis. So look at what we did here. This is year of assessment 2007. It's of course preceding year basis. It must start from July 1, 25 to June 30th, 26. PYB, preceding year basis, no problem. Now look at 2008, which we've said is the penultimate year. You must have done preceding year basis the first time, July 126 to June 2007, preceding year basis. This is what you did and submitted to the tax authority. Now the business have ended. They say come back and do actual year basis. That means this is 2008 we are talking about. Go and start your account from January 128 to December 31st. Sorry, this is 28 to December 31st, 2008. So when you do that, you get your figure. So what happened here is the tax authority will choose which one of them is higher. Tax authority will choose which one of them is higher. So that's why you see that tax authority are choosing this. Now for the final year, all you need to do is the actual year basis. So you see, start from January 1, where this one would have stopped, 28. So irrespective of whether this was chosen or this was chosen, actual year basis start from January 1 to the date the business ended. So you see, this is not 12 full months, and this is not 12 full months. And so you see that it is not normal. Here, you are having two periods compared. Look at it now. July 1, 2006, down to December 31st, 2008. It's more than 12 months period that we have considered here. So it's no longer normal. That's why we call it abnormal basis period. So the tax authority will choose the higher of the two in the penultimate year. But in the ultimate year, they are going to choose just one. Now, this is the three situations ICAN will be testing you. So now, let's look at this question. And this question has everything that we need in these three situations. So I'll read it. This is one we are going to solve. CAN Limited commenced. So you see how you know that it's commencement rule. You say commenced. or started or began. These are key words to know its commencement rule. So commenced business on, this date is important, October 1, 2001. It is important. Why is it important? Because now once you know that commencement rule is going to be used, your mind should be telling you you need 3 years. The year the business started, the second year, and the third year. How do you know the year the business started? This is the year 2001. So you need 2001, 2002, and 2003. You also need this date because you will use it in 2001. You will also use it in 2002. Now, the next thing you will do is to look at when the company keeps its accounting record. The company, however, chose December 31st as its accounting date. That's fine. This date is important because you will use it in your year 3. This date is important because you use it in year 3 to set when the business is going to end, bring the accounting record. And so henceforth, all after year 3, all your business accounting record with the tax authority will be showing December 31st every year. So this year is important because we need this date from year 3. So you have gotten 2 information that will help you in your commencement rule. Now that is not all. They said in the tax year 2006, tax year 2006 is highlighted. What happened? The company wrote to FIRS notifying the Revenue Service of its intention to do what? Change its accounting date to May 31st. So you see that the year of change, the first year of change, you have identified it as 2006. That's fine. That means change of accounting date is here. They used to be bringing December. So you see from 2/1, 2/2, they didn't bring December. This is the starting of the business. So from 2/3, 2/4, and 2/5, they were bringing December 31st, December 31st. As you can see here, December 30, okay, forget about this, December 31st. But in 2/6, they said, no, we can't be using December 31st anymore. We want to change to May 31st. So what you should be doing is, having identified 2006 as your first relevant year of change, you will need 2/6, 2/7, and 2/8. And you will say, let's do old accounting date and new accounting date. That's fine. So after that, from 2/9, you'll be following May 31st because you have changed your accounting date. So later in the year 2010, due to harsh economic recession, the company collapsed and folded. So this year 2010 has been identified as the year the business ended. That is your ultimate year. That makes 2009 as your penultimate year. What happens to your penultimate year? You will do 2 things. You will do preceding year basis, you will do actual year basis. So see all these things I underline here, these are the key words you can be underlining in your exam. Commenced, yes, this is the date it commenced. Choose 31st December as accounting date, just come up and write commencement rule. In the tax year 2006, that's the first year of change, they changed to this. Just write change of accounting date and it's shown here. And this year, 2010, is the year the business ended. So just write here, cessation, ultimate year. Then you write 2009 as penultimate year. You were given the following accounting information from when the company started operations to when it ceased. Now, normally they choose December 31st every year, but this question is so technical that I don't know what the accountant was doing. He was bringing period up to October 31st. So this is period to 31st October. If this is October 1, the business started, this is obviously a 1-month account. from October 1 to October 31st. This is 1 month account. This one would have started from November to October. This is a 12-month account. Why are they not bringing December as they said? That is not your problem. You can adjust. That is how this question was styled, so that I will also teach you how to adjust. Required. Applying the rules of commencement, change of accounting date, and cessation of business, find the assessable profits for all 10 years from 2001 to 2010. So I'm going to start operations. So let's be looking at the question side by side with the answer. Okay, now this is the question. This is the question. All right. Now we said the business commenced in October 1, 2001. That means our year one is 2001. So what do? Commencement rule, normal option. Year of assessment is 2001, which is our year one, 2001. And we said that your year one must be from the date the business started, which is October 1, 2001, and must end in December 31st of that year. So how many months do we need? We need 3 months. We need October, we need November, and we need December. How do we get the 3 months? You were given the first 1 month here. That means we need this 18,000, and we need 2 months inside here because we have our November and December here out of these 12 months. So how do we get the 2 months from here? We assume that the figures accrue evenly. In exam, we assume even accruing of figures. So that means each month is an average figure. So what we'll do here is we'll say we need 2 months out of 12 months. We'll say 2 divided by 12 multiplied by 105. That is what we did here. 2 divided by 12 times 105. So your 18,000 is here. This one gives us 17,500. And when you add these two together, we are having 35,500. Perhaps we will have to do it. Let's see it here. 2. Let's do it here. 2 divided by 12 times, what's the figure again? Times 105 times 105,000. So you see 17,500. If you add it to your 18,000, gives you 35,500. And so that is what we have here, 35,500. That's fine. Now we go to year 2. In year 2, we say that the rule for year 2 is this is 2002, which is 1 year after 2001. That's year 2. We have to start from full months. If you are in the beginning and you want to get to the end, just ask yourself, what was yesterday's date? So if today is October 1, yesterday's date will be September 30th. So this is September 30th. This is 2001. The ending should be 2002. So you see, ending 2002. So give me a moment, just 1 minute. Let me connect my charger. Okay, sorry. I had to connect my charger to phone. All right, so now we've gotten the 12 full months. We've gotten the 12 full months. So now how can we get our figures? Once again, this starts from the very beginning of the accounting date. So if it starts from the beginning of the accounting date, it means that we'll need this 18,000 because we started from the date the business started. So this is just 1 month, like we established. And we are looking for 12 months. So the remaining 11 months can be gotten from this 12 months period. So we'll simply say 11 over 12 times 105. And that is what we did. This is our 1 month period. This is our 11 over 12 times 105. So this gives us 96,250. Maybe we should do it here just as a test. 11 over 12 divided by 12. 11 divided by 12 times 105,000, 96,250. That is what we have here, 96,250. If we add it to our 18,000 plus 18,000, we have 114,250. That's what we have here, 114,250. That is what we have here. Why did I put it here first and later put it here? I will let you know. Why I put the first one here is because in the first year, we do not need any comparison. But in the second and third year, we need to also do what they call right of election and compare. And so whichever gives us the smaller value is what we are going to choose. So when we compared, you see that this is higher than this, and this is bigger and lower than this. So found out that the taxpayer will favor this. So I put it here for comparison, and I put it here as the chosen one. So once you've chosen this, you have to choose this. So now let's see the third year, how the third year is being computed. The third year is year of assessment 2003. And I told you that the third year will not be looking at this date. This date is just for first year and second year. The third year will be looking at when they choose the accounting date, December 31st. And you will need 12 full months. So if we are standing on December 31st, what is tomorrow's date? January 1. So it is January 1 to December 31st. And we are going to be looking at preceding year basis. So what do we do? 2003 is the year of assessment. That means our preceding year basis must end in 2002. And we said it's going to be December 31st, 2002. That means it must have started in January 1, 2002. So you ask yourself, where can I get January 1, 2002 account? Where can I see January 1, 2002? Let's look at this 2002. Does it contain January? When did this thing start? Of course, this one ended in October. That means this one must have started in November 2001 and is ending in October 2002. So definitely we have January here. So from January down to October, how many months do we have there? We have 10 months. But we need 12 months. We even need up to December, and we have up to October here. That means November and December could be found here. So we need 10 months from here and 2 months from here. So we need from January to October here, which is 10 months. So all we simply say is, all we simply do is 10 divided, why is this thing misbehaving? Oops, calculator. Let me use this. Then, this thing is messing up. Ten divided by 12 times 105. What does that give you? 87,500. That is what we have here. 87,500. So can you see that calculation here? Now the remaining 2 months, we are going to get it from this 120. So what do? We say 2 divided by 12 times 120, and it gives us 20,000. So that 20,000 is this. So we add 20,000 to 87,500, and we have 107,500, which we will add to this to get this figure here. Okay, now that we've gotten our year 2 figure and year 3 figure, we sum them up. We'll do the same for the right of election. Remember, we are doing right of election for only actual year basis for year 2 and year 3. So we say year of assessment is 2002, year 2. It will start from January 1, 2002 and end in December 31st, 2002. So where can we find January 1, 2002 account? Still the same year. And our December will be somewhere here. So we are going to still need the 10 months from here and the 2 months from here. So this calculation is exactly what we did here. Coincidentally, it's the same calculation we did here because these dates and these dates are the same. So we have our 107 here, 500. Then we'll go to the year 3. Year 2003, it will be from January 1, 2, 3 to December 31st, 2, 3. You ask yourself again, where can I find January 1, 2, 3? You will get it here. So from January 1 down to October 31st, 2, 3 is 10 months. So we still need to do our 10 months and we'll get our remaining 2 months here. So when we do 10 months, what do we have? Divided by 12 times 120, we have 100,000. So that's the 100,000 here. Then the remaining 2 months, we say 2 times 150. We have, it is this 25,000 we add together and you have 125,000. So when you add these two together, you are having a bigger figure. So that's why we didn't choose this one and we choose this. So this falls here because the chosen ones are here. Now, once we are done with the commencement rule, the continuation of normal basis continues from year 4. And I told you, whichever we choose, whether right of election or normal basis, your year 4 must continue from where year 3 of year ends and not this, and not where this one ends. So it continues from where this one ends. So where this one ends was December 31st, 2002. So here must start from January 1, 2, 3, ending December 31st, 2, 3. Of course, they bring their books on December 31st every year. So this is 2004 preceding year basis. So what we need to do, still our calculation, 2003 January would have started here, done that calculation. Then we also need 2 months from here. We've done that same calculation that gave us 125. Keep it here. This is 2005. 2005 means January 1, 2, 4. January 1, 2, 4 will be here. down to here, which is 10 months. Then we need the remaining 2 months here, 2 months. So 2 over what? They gave us period. We need to know how many months this period is. So we'll start counting. This period started from November 1. So we count the whole of November and the whole of December, which is 2 months. If we add January to March, which is already 5 months, to these 2 months, it's 7 months. So what we need here is 2 months out of 7. So you see it here, the first one was 10 out of 12 months. The second one was 2 months out of 7. You add them together and you will get this. Now, we go to, now because this is a period, something is happening. Year of change, we said, is 2006. How do we know this is 2006 year of change? We find out that in year 2006, you're supposed to start from January 1. Supposed to start from January 1 to December 30, to December 31st. But yeah, they told us in the question that they want to change to May 31st. So you know that in 2006 is your year of change. What do you need to do? You first of all pretend as though they never asked for change. This is based on the old accounting date. Old accounting date is December 31st. So if you look at 2006, the date is January 1, 25 to December 31st, 25, as though they never asked for change. So all you need to do is ask yourself, where is January 1, 25 located? It's going to be located here. From January to May is 5 months. So you're doing 5 over 7. 5 over 7 of that figure. Then the remaining, since you've taken 5 months, from June down to December will be here, which is 7 months. So you're taking 7 months out of these 12 months. So you say 7 over 12. When you add the figures you result from that, you have this figure. Once again, I'm putting them here because of comparison. Okay, you go to 2007, you'll be looking at 2006 record. Where is January 1, 2006? You should be here, 5 months. So you're taking 5 months out of 12. You're also taking 7 months balance out of 12. That is what we did here. 5 months out of 12 months plus 7 months out of 12 months. You get this figure. Then you go to 2008. You will need January 1, 2007 to May here, which is 5 months. You do 5 months out of 7. The remaining 7 months from June down to December, you're going to take it from here. That's the same thing we did here. 5 months out of 12 months, 7 months out of 12. And you've gotten this. You add them up together, it gives you this figure 433,286. Now, you will now come back and say, right, let me acknowledge the change. The accounting date is the new accounting date. The new accounting date is now May of that same year. So what do you need to do? This is 2006. If this is 2006 and it has to end in May 31st, 2005, preceding year basis. If this is May 2005, you ask yourself, what is tomorrow's date? June 1, then you put, because you're looking for a starting date, you go 1 year backward. June 1, 2004. So all you simply look for is for June 1, 2004. Go to 2004 accounts here. You can find June 1 here. June 1 can be located here. So from June 1, 2004 to October. So we have June, July, August, September, October. So it's 5 over 12. So if you look at it, this is the 5 over 12. Good. Now, if this is the 5 over 12, we need the balance of 7 months. Incidentally, this period is a 7 months period. So this is the period that we need balance, 90,000 plus 5 out of 12 months. That's fine. So this is the 7 months period of 90,000, which was given the first 5 months of the year. This. So you add them together, you get this. The second year is 2007. Have to be June 1, 25 to May 31st, 26. Always, when you are writing your basis period, for you to make sure it is preceding year basis, don't start writing the beginning. Just give a space, put your dash. Ask yourself, this is 2007. It must end in 2006, so you put your 2006 first. Then you ask, what is the accounting date? Accounting date is May 31st, 2006. You have achieved the ending date. Then you come back here and put 2005 as the beginning. And you ask yourself here, what is tomorrow's date? That is what you put here. So don't always come and start rushing to write the beginning, because you may be thinking, since it is 2007, you may mistakenly write 26. And you say, no, it's not 26. So always, when you are doing preceding year basis, always do the ending date first. Then you go to the beginning. It's only in commencement rule I will ask you to start from the beginning and be going forward. But every other thing, start from the ending and write 12 months back. So June 1, 2005, where can you find June 1, 2005? Of course, it's going to be here because this one is ending in May 31st. So June 1 would have been here, ending in May 31st, 2006. Exactly what we are looking for. So is that 126 we are looking for? That is it. No adjustment. Then the next one is 2008. We need June 1, 2006 to 31st May 27. Look at this account ending in 31st May 27. Must have started in June 1, 26. 180 is what we need. No adjustment. That is it here. So we add these three figures and we got this figure that is higher than this. So the tax authority will favor the one that will give them a higher figure. After that is done, you find out that your next year will continue from this new date and not the old date. Continue from the new date. So that's why you see in 2009, we are having where this one stopped, June 1, 2008 to 31st May 2008. But notice here that the business ended in 2010. If 2010 is the ultimate year, that means the penultimate year is 2009. And what year are we now? We are in year 2009. Year 2009 is our penultimate year. So that's why you see cessation rule have started, penultimate year. So what do we do in penultimate year? We do preceding year basis. Our preceding year basis will be a continuation of how this account, the new accounting date was chosen. So June 1, 2008 to May 2000, June 1, 2007, this is 2007 to May 31st, 28. So just correct it in your book, this is 2007. This must be 12 months long. So where can we find it? June 1, 2007 to May 31st, 28 is this 108. This is the preceding year basis. That's why we keep it here. Now, why did you not put it here? Is for comparison's sake. Now, we'll go back and do actual year basis for it. January 1, 29, that same year, 29 to December 31st, 29. So we are going to do comparison. Where is January 1, 29 located? January 1, 29 will be located here. Okay, so this account would have started in June 1, 28. But January 1, 29 is here. From January to May, we have 5 months. So this should have been 5 over 12. So if you can see here, this is 5 over 12 of that figure, will give us 57,500. Now, where is the remaining 7 months going to come from? The remaining 7 months is going to come from this period. You ask yourself, how many months make up this period? This period would have started from June 1 to 9. So from June, July, August, September, October, November, December, 7 months. But this is January to 10. January to 10 is another one. That is 8 months. So we are needing 7 months out of these 8 months. So you come here and say 7 over 8. That is what you need. 7 over 8, which will give you 110. So you compare 110 with 108. Whichever is bigger is what the tax authority will take. So the tax authority has taken the 110. That's why the qualified ones are here. Now we go to the last year, which is the year of assessment 210. And I told you it's the ultimate year. You choose the actual year basis. January 1 to 10 to 31st January to 10. Because look at it here. They told us that the business ended in 2010, and you can see from the statement, this is 31st January to 10. So from January 1 to 31st December, to 31st January of 210 is 1 month. And this is an 8 months period. So we only need 1 month out of this 8 months period. And that is what I've just done here. 1 over 8 times 60 will give you this, and that's what you keep here. So you should be able to do this. Whenever the dates do not correspond, whether they correspond or not, always find out how many months are in a period and keep it. Maybe use pencil and note it down. Also, if you have to be adjusting between 2 periods, if your adjustment is cutting across 2 periods, always know where your basis period starts and where can you get it. And if it does not end in that same year and it crosses to the other year, count how many years from your starting point to the end of that account that you need. Put it down. Then the remainder, check whether the remainder can carry it. And you get your adjustment. So you can be doing things like 5 over 12 plus 7 over 12, or you can be doing things like 2 over 12 plus 10 over 12. I can be doing things like 6 over 12 plus 6 over 12. These are the kind of adjustments you get to see. So you have to get your calculation right. I want you to go back again and study this example. This is a classic example of all the 3 abnormal period in one question. Now, apart from that, study the other 3 examples I will give on how to do each of them: commencement rule, cessation rule, change of accounting date. Study each of them separately, then come back again and see how it is being applied in this question. I believe you will not have any question now. I will need you to digest all that you've learned. This is a refresher course because I believe you must have done something about it before. You must have learned a bit about it, but not to worry. It's a refresher course. Feel free to go back to your book. This is the basis for tax. If you don't know your basis period well, taxation will be a problem for you. So go back and study this. Our next class with me, because you'll be having another class with another person, Desua. In our next class, which is on Saturday by 7 p.m., I believe you'll be at home. I will be giving you the capital allowances. We'll be taking capital allowances, and if you don't know your basis period, you cannot understand capital allowance because they are closely related. So take your time and study this and see what you can come up. If you have any issues, just chat me up. WhatsApp, you have my WhatsApp number, and let's discuss. Thank you so much. We've done 15 minutes over the closing time. We would like to close our class and prepare for us the next day. Any question, just chat me up in the group or privately. Thank you so much for coming to class today. See you in the next class.